Welcome back. You're watching Build Your Portfolio. UFlex reported numbers 18% growth coming in terms of the top line. The profits have seen a marginal uptick of 4% and the margins have remained pretty much flat. Let's head across to Rajesh Bhatia to get his perspective, who's the global CFO at UFlex as well. Welcome to the show, Mr. Bhatia. Overall, a pretty flattish number is what we've seen. What is the reason for that?
I think this is a tremendous, very extremely competitive quarter, and what we've seen is a huge fluctuation in the oil prices. But despite that fluctuation, I think it's really great performance from UFlex as the sales volume and production volumes both are up. The turnover is up, and we have seen 18% increase in the top line. The bottom line, the EBITDA growth at about 11% on a year-on-year basis. The PAT growth is almost flattish because of higher incidence of the taxation. And what we are saying is that despite this was a difficult quarter, so this performance is really exemplary in that regard. And on the aseptic packaging, this been the best quarter, and as we've seen the uptake in the the customers. Now we serve about 40 customers, and the Q4 and the Q1 subsequently looks good for our aseptic packaging business. So it's really going ahead, doing great now.
So Rajesh, overall, if you go to see with regards to where the flexible packaging business is concerned, usually we see the margin impact with a lag effect, and there is a delay in realizations as well. Overall, shouldn't have the margin impact come in the third quarter, or are we trying to say that the kind of the way crude has panned out has inched lower, the benefits will come in the fourth quarter then?
Yeah, because the Q3 will work on the prices in the Q2 quarter. So Q2 quarter also the prices of the crude were reasonably higher. So but Q3 we saw almost the highest price for the crude to begin with, and it kept on coming down. So I think that benefit of the lag effect we'll see in Q4 definitely.
And with regards to where the packaging film business is concerned, usually the margin impact is instantaneous. What is the reason for not seeing that growth come in there?
So there the margin impact, you're right, is instantaneous. But there also because you have the raw material stock at least for on a fortnightly pricing basis, and then your customers shy away from buying stocks when the markets are continuously falling. So there's a combined effect of all those things. So we've seen that the margins in the films also has been down in this quarter as compared to the previous quarter. But I think after middle of December the situation has improved. It's much better in January, and so we're seeing the stability back again, given that the crude is now quite range bound. So that the fear of the market that the falling prices, you should try to keep your inventories low to reduce the inventory losses is not the concern anymore.
Right, and overall you've guided for almost a 15% guidance in terms of margins for full year FY19. Do you still maintain that number? And what's the kind of uptick that we could see on the margin side in the fourth quarter overall?
I think the margin offtake, when we said 15%, was basically accounting for the aseptic packaging as well as for the uptake in the holographic new expansion that we've done. So they are a bit deferred, from this year, as both have taken a bit of more time than what we had originally thought. So also, as I've been saying, that the margins have to be seen in the context of the crude prices also, because the higher crude prices does not necessarily translate into the same margin. So while the margins per ton you getting the same, but because of the increase in the raw material prices and increase in the selling prices, So your margins in that context look a bit off-colored. So if I were to say that, with this quarter with a 3% volume increase and an 18% top line increase, so you can clearly see the difference, while the volume has gone up by 3%, the value has gone up by 18%. So I think if you were to neutralize the impact of that, I think we will still have 13.5% around margin. And when those margins are supplemented by the margins with the by the margins in the businesses which are aseptic packaging and holographic taking the shaping up, we'll definitely reach that 15% blended margin.
And Rajesh, what's the update with regards to the debt profile of the company? And with the 25% rate cut that we've seen from the RBI as well, do you think you will see any benefits coming in on that front on lower finance cost?
I think, our debt level on a consolidated level has more or less remained the same. There's been some old debt paid off and some new debt taken for the current, the capex. So more or less, we are at the same level as what we were in September What we on the rate cut definitely depends on the banks that, whether it is, really induced rate cut just to give the soft signals to the market, but I've not seen any banks really coming and announcing any decrease in their MCLR and all that. I think it will be a few days before we see any such announcements. But liquidity in the market is currently, as we understand, is very tight. So, while the RBI has done that, the real effect to the borrowers may take a bit of a while till the liquidity conditions ease.
Right. All right, Rajesh. Pleasure speaking to you, and thank you for sharing that update as well. So overall, maintaining that margin guidance as we speak, but completely out of time. With that, it's a wrap on this edition of Build Your Portfolio. Thanks for watching, and lots more lined up on the other side. Please stay tuned.